we're going to continue with the income statement. And we should know that the income statement just lists revenues and expenses, net income or net loss over a period of time. So again, to remind you, the income statement is the change in wealth. It's a flow of wealth over a period of time. The accounts on the income statement, revenues, cost of goods sold, expenses, these are temporary accounts. They are not cumulative. They are temporary, and they are only going to last for one accounting period. They are not cumulative accounts, and they are completed accounting cycles. The cycles are completed. Now, of course, revenues are asset inflows or reductions of liabilities from providing goods or services. Now, most of you think of a revenue as an inflow of assets, correct? That's easy. Right? You sell something, you get cash, or you get receivables. How does a liability decrease? We said this before the break.
When you provide the good or service?
Yeah, for the advanced collection. So the subscriptions. Right? So if you collected $1,000 from me for a subscription, every month as you deliver that product, you earn revenue, but you have a liability until that point in time. And of course, the cost of goods sold, and subtracting that out gives you the gross profit. And these are expenses, and these are the costs that we incur to generate revenue. Now, we try to match expenses with the revenue flow. So you should try to recognize revenue in the period in which the related revenues are earned. The most important expense up there for a company that provides goods, retail or manufacturing that sells products, is the cost of goods sold. Because the cost of goods sold is, as we said, a key measure. When you look at the cost of goods sold, just putting some numbers up there, it will affect the gross profit. The gross profit is critical also because that tells you the amount of revenue that you have available to cover your operating expenses and contribute to overall profitability. In this case, the gross profit is $4,000, and that is enough to cover your operating expenses. Now, of course, in the event that the gross profit declined or was negative, that would become a problem for financial analysts, and I asked this question earlier, or last class. What would you do if your gross profit was declining, if your cost of goods sold was going up? And as I said, we usually like to look at this when we analyze it in percentage terms. Revenue, which I've highlighted, is 100%. Your cost of goods sold represents 60% of sales. So that means for every dollar you sell, 60 cents on a dollar is your cost. And you're getting 40 cents per dollar as profit. If that starts to diminish or deteriorate, maybe you could raise your selling price if the market will bear that, increase in price, or you could reduce your cost. If you reduce your cost, maybe you're going to change your supplier, or maybe use lower quality parts when you manufacture, or try to control your operating expenses. And that tends to happen quite often when you see, we see these layoffs and restructurings. Companies will try to cut operating expenses, if possible, to try to make sure they maintain their profit margins if they don't have any other recourse. And of course, if cost of goods sold keeps going up, then of course you'd have to try to either cut that cost or reduce your operating expenses. Now, if you look at Target, Target has, of course, a little bit more detailed income statement. Discontinued operations, we will look at that at some other point in more detail. They just sold off, let's say, one of their business segments. But of interest to us right now is the fact that you look at the statement, when we looked at the balance sheet, it was Target Corporation balance sheet at December 31st. This is Target Corporation income statement for the year ended. These are important nuances because it's a flow statement. When you look at this statement itself, notice that their cost of goods sold is about 71%, and their gross profit margin is about 29% of sales, if you did it on a sales basis. And they have a net loss of $1,636,000,000. Now, what caused the loss in this case? It was the discontinued operation. So we'll take a look at this in more detail as we go throughout the course and the curriculum. But one of the reasons why we disclose the discontinued operations is that they might have sold off a subsidiary, or they might have sold off a division at a loss. When you look at Target as a financial analyst, why was it important for us as accountants to break that discontinued operation out separately? Well, think about the objectives, or the objective of financial accounting. It's an information objective. Provide information to project cash flows, to project operating performance. So the question is, what is a better predictor of future cash flows? Is it net income, or is it continuing operations? Which number would you use? Would you project, if you were doing a forecast, would you start with the net income, or would you use continuing? And why? What do you think? Somebody's got an idea. It's a harmless answer if it's wrong. What do you think?
Continuing.
Continuing, of course. Yeah, I mean, the discontinued operation is a one-time event, and it will not have future implications for the company. Right? Unless you read further and you find out they're getting out of this business because, let's just say, this happened to some chemical companies operating in different parts of the world, regulation becomes so stringent in certain countries or certain areas of the world that I'm closing up my subsidiary in one country, but the neighboring country has the same policies, I'll be closing up there as well. So now this could become a recurring problem. But this, if it's not recurring, the continuing operations is the number that you want to look at for the future projections of the company. So the discontinued operation represents the profit or loss that was attributable to a segment or a division that you sold off. And again, we'll see details on that as we go along, but the purpose of breaking it out separately is to enable you to achieve the objectives of financial reporting. And issue gross profit, and of course, operating expenses, you know, are from the normal operations of the business. And of course, revenues be already defined as increases in assets and reductions of liabilities. These are caused by the company's normal operations. What would you do, and I left this off purposely, but I have a note to make sure I cover this. How would you classify a gain, and what's the difference? They both kind of look like revenues. What's the difference between them?
Well, you can get gains from just stock, for example. We were talking about rotating capital, right? Isn't that a type of gain that does not affect the revenue?
Well, not issuing stock, but selling an investment.
Right.
Selling off an investment. So the difference is,
Gains is from the discontinued.
Yeah, it could be from discontinued operations. It could be from selling off plant assets. So the example would be if Dell sells a computer, it's revenue. If Dell sells a computer, it's revenue. If General Motors sells its computers, it's a gain or loss. It's not part of normal operations. So basically, this is from normal operations. Example. Sale of inventory. Gains would be non-operating. And that would be like a gain on sale of investments or gain on sale of equipment. And so, again, why do we break this up separately? Well, let's take a personal example, which I always like to do, and that is, what if you were applying for a mortgage? What's the equivalent of your normal operating inflow? What would the bank be looking at? Your salary. What they're not going to consider is the fact that you sold off some investments and had a gain. Or you sold a car for a gain, or you sold a house for a gain. That's non-recurring. The bank cannot rely on sales of your investment portfolio as the primary source of paying off that mortgage. And that's why we separate gains, operating and discontinued operations as well. That's why these are separate. And the same thing's true with expenses versus losses. Expenses are decreases in assets or increased liabilities. When you have an expense, you either pay it in cash, you decrease an asset, or you increase a liability if you don't pay it. And it is part of your normal revenue generating ability. Cost of goods sold, you have some non-operating costs as well, but the difference there would be an expense versus a loss. The expense is normally from operations. Example would be salaries. And a loss would be loss on sale. This would be pretty much non-operating. And we define operations a little bit loosely from time to time, but just think about it, not part of your normal operations. Loss on sale of investments. All right, so expenses and losses are shown separately for purposes of making sure you know what's part of the company's recurring operations, and this is what it basically tells you right here. Of course, we know that revenues and expenses are deducted, or expenses are deducted from revenues to get the net income. And of course, we also have other expenses that are related to the company's financing and investing activities, like interest revenue or interest expense. And these are usually separated as non-operating items. So interest and dividends and interest expense are usually broken out as non-operating items. And of course, recurring, as we said, and that was the point we made about the discontinued operations. Recurring items are what we expect for persistence into the future, for projections. And of course, non-operating items or non-recurring items are unlikely to occur very, very frequently. All right, so I don't know if you have any other questions on the basics of revenue recognition and expense recognition. So just want to make sure that, and again, sometimes you have to be careful because this term operating could be a little tricky, but in general, your normal operations will generate revenues and expenses. Outside of that, you've got gains and losses that would be your non-operating.